Good day, fellow investors. One of the most requested stocks for me to analyze in the comments was Best Buy. And a great comment from Alan here. So he made a quick valuation, so almost no debt, repurchasing shares at a rate of 5% over the last 5 years. Free cash flow margins have been growing steadily over the past years. Generous dividend at this price, which eats up less than 30% of their cash flow. So all looks really good. And now the investment thesis, assuming no growth at all for the next 10 years and 5% thereafter, and that they keep printing the current 2.2 billion in free cash flow and repurchasing share at a slower 3% rate going forward, he gets a valuation of 104. If they can maintain their current 5% revenue growth and 5% margins, then he gets a valuation of 145. So let's make an analysis to see if there are any red flags for that valuation. Further, also, Morningstar sees the value in the midst of Adam's valuation, so between 100 and 145. The stock is, as I'm filming this on Friday, the 3rd of June in the morning, the stock is at 81.26, down 24% over the last months, 30% over the year, and from the November peak down more than 40%. And this is usually the case when it comes to stock requests that I get. The stock price is high, it goes down, and everyone is asking themselves whether it is value. And the usual situation is that, okay, you see it here it really crashed, likely negative earnings or something. And now you see this much lower and you think, okay, it should be a better buy than it was in November 2021 at the peak. That's mathematics. It's definitely a better buy now than it was here because investing is, after all, about price. However, if you look at it from a longer term perspective, the stock price is still, let's say, 40–50% higher than it was 5 years ago. So that is still something to think about, okay, is this just the exuberance as retail boomed, or is it something more? And therefore now really representing value. If we go back further, then you can see that Best Buy had very bad days in the early 2010s, and then it rebounded really well. For valuation purposes, keep in mind the market capitalization of 18 billion, the price earnings ratio is really low at 9, and the dividend yield is high at 4.37%, which indicates from a fundamental perspective that this should be value at current levels. So let's discuss a little bit the business, then go into the valuation and conclude as always with the investment thesis. If you enjoy stock analysis videos where we value them from a risk-reward perspective, analyze that like button, subscribe and hit that notification bell so that you see in your feed, okay, this is a video I'm interested in, this is a video I get value from, and then watch it. Let's dig into Best Buy. So from a business perspective, retailer, electronics, so nothing really special, but has done well over time, grew, and we have it now here as an investment. However, if we look at what analysts have said about the business especially over the last quarter and the last earnings, and you can see here, especially here, after the earnings came in, after this dip, here, now analysts changed their mind, of course. Rating and price target cuts from Wall Street. Barclays is cutting its rating on Best Buy and cutting guidance for the second half of the year on inflation, on less purchasing power, higher costs, lower margins. But they say that next year remains optimistic. So it will be a buy before Wall Street turns optimistic. If we dig deeper into what they said, yes, it has levers to reduce expenses, but they don't think that the company will be able to do that to keep the cash flows high. And of course, inflationary environment, rising interest rates, and surging energy prices will impact the purchasing decisions of Best Buy's low-end customers, less sales leads to lower margins and less profits. And as they say, this will be likely tough to mitigate for Best Buy. And look at the price targets declines. So from 135 to 80 because the stock dropped to 80 now. So Citi also to 65 from 80. Piper Sandler, probably they lowered it from 130 a few months ago. So from 144 now to 91, and you can see here exactly that the high was as was their high target and the low was at their low target. So that's analysts, and now we have to see whether there is value there or not. And the company is just doing their business. Of course, it's normal to have ups and downs in the sector. But if we look at earnings a little bit, they also have revised their financial guidance to reflect better estimates now. And the key question is whether this slowdown is structural or just temporary. They anticipate comparable sales to decline, but to keep operating income steady. And if we look at the fiscal year 2023 guidance, revenue to be a little bit lower than expected. Of course, a big decline to comparable sales, so this lowers your margins and your profits. As I said, lowering margins, but still they expect to spend 1.5 billion on share repurchases, and they have lowered the earnings per share just a little bit. And now the key question is whether this is a structural or temporary decline. Retail is a tough business, and once you start declining, it can get really ugly, as we have seen with the stock chart for 2012-2013. And that's what analysts worry. They don't want to make a mistake there and see it go lower, so they lower their targets. If it goes lower, they will lower their targets even more. That's how analysts work. However, we have to see, okay, what's the value, even in the worst case scenario, and then see how it fits our portfolio compared to other investments. If I look at the business, so not really much growth in revenue. There have been ups and downs, and there has of course been the recent boom as we all ordered something, went to buy things for home. So this is expected to decline, as they said, 3 to 6% revenue decline. That should also push margins a little bit lower and therefore also net income a little bit lower. So maybe this is just an outlier, so the 2.5 billion in net income, maybe it will just return to 1.5 billion as it was the case in 2019, but there were also losses in 2012 that are a little bit different. However, the free cash flows have always been there, which means the company is a good company and will likely do well over time. So let's make a valuation. So here is our table that you can download, and by the time the video comes, this will all be filled. So let's do it together now with Best Buy. Now, what will be the input per share? Let's take free cash flows and then start from there, because we are always looking at the margin of safety when it comes to invest. And those free cash flows were 2.5 billion, but let's say that those fall to 1.5 billion per year going forward. And then we have to assume no growth rate at all going forward, which means zero growth rate depending on the discount rate and the terminal multiple the market will give it on the cash flows. If we say 15, the market is happy with 15, then the present value, the intrinsic value, is 18 billion. If we compare to the market cap for a 10% return, that would be fairly valued. But of course, cash flows have been much higher, so if they have higher cash flows, the stock will go, of course, higher. But with lower revenues, with the slowdown, this is unlikely. This was likely the peak of, let's say, taking advantage of the environment, but now I am seeing a slowdown there, which means that this as an investment is risky. To put it in a stock price perspective, for easier comparisons, so 1.5 billion would be 6.75 of free cash flow per share. Of course, they are guiding to 8.5 as the earnings are in line with free cash flows, and if that happens, you are already at an intrinsic value of 101. However, always keep in mind that the market usually, with no growth, the P/E ratio usually goes to 10. And then here you have a valuation that is much lower and not really a great bargain. Of course, expecting a 10% return always. So let's make just a valuation. Let's leave it like this. If there is no growth, if there is, let's say, 4% growth over time, the terminal multiple of 15, the market likes it a little bit more, then yes, the stock price will be higher. And worst case scenario, we can always do -2, -2, -2, and then of course the terminal multiple also goes lower, which leads to a risk if they can distribute these things to shareholders. Of course, if you do buybacks at prices and then those stock prices decline, then you're actually destroying shareholder value. But they pay a dividend, so that should lead to safety. And as Ellen said here, it is all about the assumptions, what they can keep doing. Can they keep printing the current cash flows? This will likely be lower because last year was really a good year, so going forward it is a little bit lower. And this is the investment thesis. It is, yes, a good business, high cash flows, but there will be these ups and downs, and we have seen analysts retreating, so I wouldn't call it an absolute bargain. It looks okay, nothing wrong with it, but also nothing stellar from my investing perspective. It's not that it will be an 8x or a 5x 10 years down the road, because there is high competition, margins, always something, and plus there is this internet thing where you can now choose more and more. So if people go less to these shopping centers and areas where Best Buy is, that will be also slower for them. So there are these advantages and disadvantages, and you just have to see how owning such a business fits you. I personally think there is better no matter the valuation, because I'm not looking at a possible 2x 50% jump here or there, because that is something that over the long term, if you look for those, yes, you will get a 2x or 50% jump here or there, but over the long term your portfolio will be full of things that didn't 2x but just went lower and slower. So that's the risk of reward of Best Buy. I don't like it. I will not dig deeper or follow it, and I hope I have given you some value with this analysis. Thanks for watching. Smash that like button, because that's the best buy for this channel, and I'll see you in the next video.